Today, we are taking a pretty big stack of source material spanning cutting-edge research to some really deep financial critique.
We are.
And we're going to perform, well, a structural checkup on what is maybe the most intense economic story of our lifetime, the great AI paradox. I mean, you can't escape it. We are seeing a boom that is just fueled by staggering amounts of capital.
Trillions of dollars.
Exactly. Trillions committed to building what feels like an entirely new technological civilization. And the capabilities of these new models are, well, they're frankly bordering on the unimaginable.
They really are.
But here's the paradox, right? Is this incredible investment laying down some, revolutionary infrastructure that's going to pay dividends for generations?
Yeah.
Or are we watching in real time one of the biggest capital mistakes in history?
Is the money just being spent faster than the tech can actually justify it?
That is the core question.
Yeah, and that's the conflict we're diving into. Our sources today, they distill this remarkably candid and I think revealing debate between three heavyweights.
Okay, let's introduce them.
So first you have Michael Burry. He's the investor famous for, seeing the structural financial risks before the 2008 crisis.
The ultimate skeptic.
The ultimate structural skeptic, yeah. Then you have Jack Clark, a total AI insider. He co-founded Anthropic. He's actively building the frontier models we're talking about.
So he's on the front lines.
Right. And finally, Dwarkesh Patel, who's kind of the tech observer here. He interviews basically every major leader in Silicon Valley.
So he has the pulse of the whole industry.
He really does. And what's interesting is this wasn't, your standard celebratory conference panel.
No, not at all.
They weren't just asking if AI is cool. They were asking these raw, essential, and frankly, pretty jarring questions.
Right.
Like, can the current global financial structure actually absorb this kind of disruptive shift? Is this massive investment path even economically viable when, the verifiable revenue streams are still lagging so far behind the infrastructure build-out?
So our mission today is to basically adopt their framework. We are going to look past the daily stock moves and the latest shiny demo video and really focus on the underlying plumbing. What are the non-negotiable economic realities that have to hold true for this whole AI revolution to actually succeed?
And the trio, they concluded that you have to track 5 core variables. It's that simple. If you ignore these, you're just, you're trading on hype, on momentum. But if you track them, you get a really clear signal as to whether this boom is built on solid rock or maybe some very shaky sand.
Okay, let's establish the structure right now so you know exactly what metrics we're tracking throughout this deep dive. Our 5 non-negotiable lines for judging AI's trajectory are...
Okay, lay them out.
Number 1 is capability. Simple question. Is the technology still improving exponentially, or is the core research starting to hit a wall? The tech has to keep accelerating.
Non-negotiable.
Number 2, efficiency. Can we reliably and maybe more importantly, measurably track production gains in real-world settings? Or are we just kind of experiencing the illusion of speed?
The vibe of productivity versus the reality.
Exactly. Number 3, capital return. This is really Burry's core thesis. Is the return on invested capital, the ROIC, is it supporting the mind-boggling scale of the hardware and data center spend?
Is the money coming back?
Is the money coming back efficiently? Number 4, the industry closed loop. Is the tech moving beyond just being a useful tool and genuinely integrating itself into complex, real-world, high-stakes workflows, without requiring constant human babysitting?
Can it run on its own?
And finally, number 5, and this might be the big one, energy supply. Is the physical power grid actually ready for this unprecedented and still escalating energy demand? Because, ultimately, if you can't plug it in, it doesn't matter how smart the algorithm is.
Physics always wins.
It does. So we have to start with capability because this is the foundation of all the optimism, right? Let's jump into segment 1 and detail the technical genesis that got us here. It starts with a pretty surprising shift in R&D strategy that completely redefined what we thought AI was even supposed to be.
Yeah, to really get where we are, you have to look back to, say, the mid-2010s. The major industry bet around 2017, the path that researchers were pouring billions into, was all about achieving generalized intelligence by training these tabula rasa agents.
The blank slate approach.
The blank slate, exactly.
Right. The idea was it was behavioral. You expose a blank agent to a really complex environment, and you just force it to learn through millions and millions of interactions. I'm thinking of DeepMind teaching agents to play these super complex games.
That's the perfect example. They really believed that by training agents through these incrementally difficult, very specific tasks, mastering StarCraft or Dota 2 or the game of Go, that the pressure would just force a generalized, robust cognitive system to emerge naturally.
And the results were, they were spectacular in those narrow domains.
Oh, absolutely. We saw what Jack Clark described as in-distribution superhumans.
They were unbeatable in the game.
Unbeatable.
But completely useless outside of it.
Precisely. They were brilliant within the very narrow scope of that one environment, but they just lacked any ability to translate those skills into general real-world problem solving. So that initial, very highly publicized path to AGI, it basically failed to deliver.
Okay, so the current boom, the whole ChatGPT and Claude revolution, that came from a totally different, almost academic pivot. What was that pivotal shift?
Well, it was really catalyzed by two massive simultaneous breakthroughs that just changed the entire math of AI development. First, this 2017 paper, Attention's All You Need, introduced the transformer architecture.
Okay.
Before this, models relied on something called recurrent neural networks, or RNNs, and they processed data sequentially. So they had to read the first word, then the second, then the third.
Which is really slow and inefficient if you want to scale up.
Incredibly slow. And the transformer changed that fundamental limitation dramatically.
Right.
It allowed for massive parallel processing. So it could look at an entire body of text, or the whole training set, all at the same time, assigning weight or attention to the relevant sections all at once. And this suddenly made pre-training on huge, diverse, generalized data sets efficient enough to be feasible.
So if you were building a model before, it was like reading a very, very long book, one word at a time.
Yeah.
The transformer is like spreading that entire book out on the floor and having 50 people read different pages simultaneously.
That is a perfect analogy. And then the second breakthrough, which came shortly after, was the discovery of the scaling laws.
Right.
Researchers found they could accurately predict a model's capacity, its performance level, and even its emergent properties based almost linearly on three input variables: data quality, data quantity, and compute power.
That must have been a completely mind-blowing realization for the technical teams.
Oh, for sure.
Suddenly, AI development isn't a gamble anymore. It becomes a resource allocation problem. You put in X amount of dollars and Y amount of data, and you can pretty much predict you'll get Z level of performance.
It shifted the entire industry bet. The new strategy became just pour in massive, overwhelming resources using this new, efficient transformer structure, and a generalized capability will emerge as a kind of statistical property of the data. You don't have to manually engineer it through some game environment anymore.
And we can already see the pendulum swinging back to that agent idea, but it's with a massive, massive upgrade now.
That's exactly right. Today's highly functional agents, like DeepMind's Sema 2 for complex 3D worlds, or Anthropic's Claude Code for programming, they're only successful because they are, and this is the key, standing on the shoulders of those huge underlying pre-trained models like Gemini and Opus.
So the LLM is the engine.
The LLM is the engine, and the agent architecture is the steering wheel and the transmission. You need both.
This brings us to what might be Jack Clark's most crucial insight for us, the observers, which is that this is the floor, not the ceiling.
This point is, I think, missed by almost everyone who doesn't work directly at a frontier lab. Since the capabilities scale with resources, and the world is still pouring unprecedented capital into those resources, the capabilities you see today are the absolute lowest they will ever be for the foreseeable future.
Wow. So if you had a slightly frustrating experience with ChatGPT back in, say, late 2023, you need to understand that that model is effectively ancient history now.
It is ancient history. Clark emphasized this. He said, if your impression of frontier tech is even from last November, your view is seriously outdated. The exponential improvement is happening on such short cycles, we're talking weeks, not months, that public perception is always playing catch-up.
And the surprise factors that are emerging from this process, they're kind of the proof that the models are developing these general capabilities we didn't explicitly program into them.
Yeah, the most startling example that was mentioned was multilingual proficiency. Researchers train these models primarily on high-quality English data, right? But the resulting LLMs accidentally acquired near-perfect, high-quality translation capabilities in dozens of other languages.
So they could, translate a CNN article into Japanese flawlessly, even though that wasn't the goal?
Flawlessly. And that's incredible. It suggests the model didn't just learn English, it built some kind of internal conceptual map of human language and logic that's robust enough to operate across linguistic boundaries.
It implies they're constructing these internal world models that are way more interconnected and generalized than we ever gave statistical models credit for.
And this emergent property is the technical reason why insiders remain so bullish. The system is teaching itself more than we are teaching it.
Okay, so that covers our first variable, capability. Check. The technology is accelerating, the ceiling is nowhere in sight. But here's where the paradox really kicks in. If the models are getting smarter every week, why are the corporate giants spending money like, as we said, drunken sailors, when the revenue hasn't materialized?
Right.
That contradiction forces us directly to segment 2, the structural risk, and variable number 3, capital return.
Yeah, we really need to acknowledge just how staggering the current investment is. The entire AI boom, this multi-trillion-dollar global hardware competition, was triggered by a chatbot. ChatGPT, which had pretty limited initial use cases. It was mostly search enhancement, students cheating, and some programming assistance.
It's the sheer scale of the investment that's so unprecedented. Historically, investments in infrastructure, they follow proven demand. You build a new factory when your current factory can't meet the order backlog.
Of course.
But the AI boom is operating on the complete inverse model. Build multi-trillion-dollar infrastructure first, and then wait for the demand, the revenue, the killer applications to just materialize later.
And Burry called this model highly unusual in investment history. It's a massive collective bet on future productivity gains that may or may not arrive on schedule.
And this structural bet, it's fundamentally changing the balance sheets of the biggest tech companies on the planet. Dwarkesh Patel cited this critical admission from Satya Nadella.
What was that?
He said major software companies like Microsoft are no longer purely software companies. They are now capital-intensive hardware companies.
And that's a seismic shift.
It's huge.
Yeah.
They used to sell digital licenses with basically zero marginal cost, enjoying these, virtually 100% gross margins. Now they're building literal cities of data centers and constantly refreshing entire fleets of specialized bespoke AI chips.
And the financial consequence of this shift is profound, and it's what keeps someone like Burry up at night. The traditional software analysts, the ones who thrive on predictable subscription revenue and low maintenance costs, they're struggling to accurately model the massive requirements for maintenance capital expenditure.
That's the key. Freeze.
It is. It's the perpetual, ever-increasing cost just to keep the infrastructure running and current.
And this is the absolute crux of Michael Burry's structural thesis, and it all revolves around return on invested capital, or ROIC. For him, ROIC is the ultimate long-term predictor of a company's success. It measures how much profit a company generates for every single dollar of capital it invests.
So how efficient is your money?
Exactly. And historically, the big software companies were ROIC superstars. Why?
Because they had almost no tangible capital to invest. Their main investment was in, employee salaries?
Right. They sold the same piece of software millions of times over. So their ROIC was stratospheric. If you invest $1 and get back $3 in profit, your company is incredibly efficient.
But Burry argues that the massive capital expenditure required for AI construction, the new data centers, the cooling systems, the chips that need replacing every 2 years, is causing their ROIC to tumble rapidly.
So even if the company is getting bigger, it's getting less efficient.
Drastically less efficient. If you suddenly have to spend billions just to maintain parity in the AI race, and that spending is far, far outpacing the verifiable revenue being generated by AI apps right now, the profitability of that invested capital just shrinks.
Yeah.
The company might still be growing in absolute size, which is what the market often rewards, but the efficiency of that growth is plummeting.
And according to Burry's sources, nothing predicts long-term stock trends better than the direction and the speed of that ROIC change.
And the direction, thanks to CapEx demands, is down.
I think we need to stay on this for a minute, especially the core accounting risk, which they call the depreciation nightmare in stranded assets. It sounds like boring accounting, but this is actually where a crisis could be hiding.
It is the most significant structural risk, without a doubt. So depreciation, it's the accounting practice of spreading the cost of an asset, a server rack, a cooling unit, over its expected useful life.
Standard stuff.
Right. If you buy a server for $1 million and you expect it to last 10 years, you report $100,000 in expense each year.
But the problem is that these accounting practices, they were designed for buildings or standard hardware that might actually last 10 years.
Exactly. AI chips and data center components are technologically obsolete within 2 to 4 years. The pace of innovation is just relentless. So Burry contends that if these assets are being accounted for using a traditional long-term schedule, say depreciating a high-end chip over 7 years, it's artificially inflating current profits.
Because the expense is being stretched far beyond the asset's real-world lifespan.
You got it. So we're booking profits today based on an artificially low operating expense because we're just ignoring the reality that the chip we bought will be a paperweight next year.
And that's the stranded asset risk.
That's it. If the technology becomes obsolete, and we know it will, before the depreciation schedule is even halfway done, the company is left with an asset on its books that is worth nothing, but still has years of remaining book value. When they're finally forced to write down that loss, it could absolutely crush profits.
And there's an accounting maneuver that helps companies kind of kick this can down the road called capital in progress, or CIP. This sounds really opaque, but it's critical to understanding the risk here.
CIP is it's essentially a holding category for capital expenditure. If a company is building a data center, the cost of the construction and the cost of the chips being installed, they all go into the CIP account.
And a crucial part.
The crucial part is that assets in CIP do not begin depreciating and do not reduce reported earnings until the asset is officially considered put into use.
Wait, so a company can buy billions of dollars worth of chips, put them in a data center, and as long as they don't flip the on switch, that massive expense just doesn't show up in their depreciation numbers.
That's the risk. If AI application revenue lags far behind the infrastructure spending, Burry suspects companies could have a massive backlog of concealed, stranded, or soon-to-be obsolete assets just sitting there in CIP.
And when the market or the auditors force them to finally put them into use,
the resulting depreciation expense could be massive, suddenly revealing huge losses that were completely hidden from the current earnings statements.
And we have concrete evidence of this risk being taken seriously by the industry, which is what gives Burry's whole critique so much weight.
Yes. Nadella, in that interview, he reportedly admitted to slowing down or even pulling back on some construction projects that involved older generation chips.
Why would he do that?
To avoid being instantly locked into the depreciation cycles of those older, less efficient chips that would become stranded assets within months. Pausing CapEx like that is a crystal clear sign that the technological half-life of their assets is a massive, massive headache.
Okay, I want to challenge this point for a second because it sounds really difficult. You mentioned stranded assets. Couldn't these older, less powerful chips just be repurposed for other, less demanding tasks? I mean, does a chip running an internal billing system also become stranded?
That's an excellent counterpoint. And yes, in theory, older hardware can certainly be repurposed for traditional cloud tasks or for running smaller, less complex models. The danger, though, lies in two areas.
Okay.
First, the majority of the current CapEx is going toward these highly specialized, power-hungry accelerators, the GPUs and TPUs, that are optimized for the highest-end LLMs. Repurposing those for simple tasks is just less efficient than using cheaper standard CPUs. And second, the sheer volume of new hardware being produced means that the market for used, specialized AI hardware might just collapse, driving its salvage value down to almost nothing.
So the question is less can it be repurposed and more can it be repurposed profitably enough to support the debt they took on to buy it?
That's it, exactly. And speaking of debt, we need to touch on the financing side. If the public market is getting skeptical, where is all this money coming from?
Right.
Well, the private credit markets are heavily financing this boom, possibly even exceeding public market financing in sheer volume. And this introduces a second structural risk, duration mismatch.
Explain that for us.
So the data centers and the hardware inside them, they're being securitized, bundled into these tradable financial products based on the assumption that the assets will last 20 years. That's what supports long-term, low-risk debt.
But we just said the chips only last 2 to 4 years.
Exactly. The hyperscale cloud providers who lease this space, they often have contracts that allow for equipment refreshes or even exit opportunities every 4 to 5 years. So if the tech becomes obsolete in 4 years, the asset value plummets, but the debt securing it still has another 16 years left to run.
So Burry's argument is that the technology is moving at the speed of light, but the financing mechanisms are moving at the speed of a snail.
And that creates a dangerous gap between the asset life and the debt duration.
If that gap opens up, the structural fragility could be significant.
It would be huge.
So on one side, we have mind-blowing technical capability. On the other, a financial structure that seems to be held together by questionable accounting and long-duration debt. This brings us to the messy middle ground, productivity. Why isn't anyone making any money if the tools are so good? Let's move to segment 3, the productivity measurement problem.
This is the absolute crux of the paradox that Dwarkesh Patel kept coming back to. If these models are genuinely superhuman on benchmarks, and, we can forget the Turing test, they're solving complex math problems, they're generating production code, why hasn't half the white-collar workforce been replaced?
Yeah, the expected job apocalypse just has not materialized. The models are immensely capable, but the impact on real-world workflow efficiency remains, at best, diffuse and really hard to measure, and at worst, microscopic.
And the core gap lies between that benchmark performance and real-world utility. When the models are tested on these clean, simple, constrained problems, they excel. When you integrate them into complex, unstructured, real-world workflows, like, say, drafting a legal brief that involves multiple conflicting sources and regulatory compliance and client context, the models still have a critical flaw.
Which is?
They make egregiously ridiculous or implausible errors that no human subject matter expert would ever commit.
Right. They hallucinate.
They might nail 99% of the task, but that 1% error is a hallucination so profound that it just ruins the entire output.
Right.
And crucially, even those advanced models, they really struggle with self-correction. When they make a mistake, they tend to double down or just spiral into further error.
And in knowledge work, the cost of that one spectacular occasional error is enormous.
Of course.
If you're a lawyer or a doctor, a single catastrophic error completely outweighs the benefit of completing 10 other tasks in half the time.
Absolutely. So seamless integration is therefore blocked by three things: the error rate, the lack of effective self-correction, and the lack of clear accountability chains. Until we figure out who is liable when the AI gives bad legal or medical advice, the human has to remain a high-paid checker of the AI's work.
And that just limits the efficiency gains.
It caps them. And this capability gap is reflected in the wild, totally conflicting data we're seeing on productivity gains. Let's dive deep into the conflicting metrics that the sources flagged.
Okay.
First, you have these really sobering results from the Nvidia study, which looked at professional developers using AI coding tools. This study showed a completely counterintuitive 20% decline in efficiency for developers working in familiar code libraries.
Wait, a decline? I thought these tools were supposed to make programmers into superheroes. So you have surveys saying users report massive increases, but measured studies show a decline. That sounds like a complete indictment of the technology's readiness.
It sounds like it, but the theory is a bit more nuanced. The AI generates code that, it looks plausible, but it's often subtly incorrect or inefficient within the context of the larger code base.
So it creates hidden problems.
Yes. The human developer then has to spend more time debugging, refactoring, and correcting the AI's output than if they had just written the correct code from scratch in the first place. The low-quality output added technical debt faster than it added efficiency.
Okay, but then you have the diametrically opposed evidence from the Anthropic survey.
Right.
In that one, 60% of Claude users reported a massive 50% increase in their self-reported productivity. How do you square that circle?
This is where we hit the concept of vibe coding, or perceived productivity. The hosts all agreed that the subjective feeling of productivity may not match the actual, quantifiable return on investment.
So why do we feel 50% faster?
Because the friction of starting a task is dramatically reduced. You don't have to face a blank page anymore. The model gives you a running start, and that just lowers the cognitive load.
So I feel great because I got a draft of that email in 30 seconds, but then I spend the next 4 hours fixing the draft. The net outcome might be neutral, but my subjective feeling is high satisfaction.
Precisely. You've traded the friction of creation for the friction of verification. And this conclusion highlights that the industry desperately needs better process instrumentation.
What does that mean?
You need a finely tuned process dashboard that tracks true, verified ROI, not just the subjective feeling of speed. Until companies can measure the output accurately, they risk chasing a high feeling that doesn't translate to Burry's bottom line concern, that ROIC improvement.
This whole struggle brings us to the necessity of the closed loop. We see that programming has been the fastest adopter of AI, and this is entirely due to its structural nature.
Programming is inherently or naturally closed loop. You generate code, and the process gives you instantaneous feedback.
Right, you compile it, you run tests.
You verify it instantly through compilation, unit tests, runtime checks. You push it to production, and you see if it works. If it fails, the error is usually pretty easy to identify and fix.
But in most other knowledge work law, academic research, consulting, strategic planning, The feedback loop is open loop.
Totally open. You generate a massive, complex document, and the verification of its accuracy, its internal consistency, its fitness for the purpose, requires this enormous human undertaking that can take days or weeks.
So the next major step function in efficiency, according to Jack Clark, is expanding this closed-loop functionality beyond just code.
Right. This means giving LLMs web search access, the ability to connect to external databases, and tool use capabilities, so they can begin to automate parts of the verification process itself.
Okay, so for example, instead of just drafting the legal brief, the model has to be able to cite the relevant case law, verify the facts against public records, and structure the argument based on predefined client constraints, and then check its own work.
Exactly. Until that self-verification capability is robust, the human remains a high-paid checker, and that just limits the diffuse, widespread efficiency increase that we're all expecting. When the closed loop expands to broad knowledge work, that's when we'll finally see the increase in efficiency that justifies the investment.
So we have capability, questionable efficiency metrics, and a fragile financial structure. Now, let's ask segment 4's crucial question. Who wins this war, and what happens if AI just becomes universally cheap?
In every previous tech cycle, whether you're talking operating systems, search engines, or social media, a winner-take-all platform model emerged.
Right, creating these massive, durable monopolies.
But that is not what we are currently seeing in the world of frontier AI models.
No, instead they described what they called the rotating podium.
Which is a perfect descriptor. The current reality is a high-competition field. The leading advantages in the core foundation models, the absolute best performance on a specific benchmark, are proving to be not durable.
Why not?
Because of rapid talent flow between the labs, fast ecosystem diffusion, and just constant reverse engineering attempts by competitors.
So you see Google, OpenAI, and Anthropic just constantly trading places for the top spot. One week, one is better at reasoning. The next week, another is better at coding.
And the implication of this intense competition is profound. The coveted idea of recursive self-improvement.
The singularity, basically.
The idea where the AI starts designing and optimizing its own architecture or training process, creating this runaway compounding advantage. It isn't yet strong enough to overcome the forces of diffusion and competition. If it were truly recursive, one lab would have pulled away rapidly and locked in a massive, unassailable lead.
Okay, so since no one is locking in the lead, this continuous battle leads directly to the cost-profit hurdle.
Yeah, the fundamental problem here is that LLMs are incredibly expensive to run, especially when they scale to inference. Training a model is a one-time expensive cost, but inference, every single query a customer makes that requires compute power and draws electricity. It's a massive, recurring, highly variable cost.
Whereas traditional software's marginal cost of serving another user is basically zero.
Right, but AI's marginal cost is non-zero, and it's tied directly to the price of electricity and the cost of the chips.
So if the competitive field stays high and the advantages remain fleeting,
the market forces will just inexorably winnow the field down to the lowest cost provider. Burry explicitly suggested that Google, with its existing global infrastructure that was designed for a low-cost search engine, may be structurally positioned to win this coming commodity war.
That shifts the entire battleground. It's no longer about who has the absolute best algorithm, but who can run a sufficiently good model for the lowest possible operational cost.
And that leads us to what might be the biggest economic downside risk of all, the deflationary trap.
Okay. If the AI revolution is primarily just a massive efficiency engine that lowers the cost of everything, we have to ask, where does the immense profit that justifies trillions in infrastructure spend actually come from?
Let's just look at the market size for a second. The total global market for enterprise SaaS software is less than $1 trillion. If AI's main utility is replacing highly paid humans or highly priced software tasks, say, replacing a $500 seat license for advanced data visualization with a $50 AI output, that's an incredible gain for global productivity.
But it's profoundly deflationary for production spending.
The value flows to the customer, not to the producer.
Right.
Burry used this brilliant escalator analogy, which is often attributed to Warren Buffett, to illustrate this structural risk.
How does that go?
Imagine you run a department store. The competitor across the street installs an expensive, brand new escalator. So you are forced to install an equally expensive escalator just to stay competitive.
Right, you have to keep up.
In the end, the total cost of doing business has skyrocketed for both of you, but nobody gained a lasting profit margin improvement or a competitive advantage. The value of that huge investment flowed entirely to the customer, who now enjoys easier access to the goods.
So, If everyone benefits equally from the universal availability of cheap AI tools, the trillions spent on data centers essentially turn into a global compulsory escalator installation.
And the competitive margins are competed away instantly.
Wow.
So that's the core question that has to justify the current scale of investment. Can AI create entirely new, non-cannibalizing expenditure categories, new industries, new forms of work, entirely new markets? And can it do it fast enough? Because if AI merely makes the old work 10 times cheaper, the current investment bubble is a structural financial trap for the producers.
That is a staggering realization. Okay, we have covered capability, capital return, efficiency, and the industry closed loop. That brings us to our final variable, the ultimate physical limit on the entire AI revolution, which we cover in segment 5, energy.
So the conversation reached a very strong consensus on this point. The biggest bottleneck facing the entire AI endeavor has nothing to do with algorithms or finance, but with physics. The ultimate constraint on the AI revolution is electricity supply.
This is just a fundamental physical limit. If the current trend continues, data centers will soon demand power equivalent to powering small nations. And the demand is still escalating exponentially.
Clark confirmed this. He stated, pretty unequivocally, that power supply has become the absolute hard constraint. If you cannot procure the electricity, you can't train the model, you can't scale inference, and the entire technological revolution just grinds to a halt. The revolution will literally be written in kilowatt hours, not in lines of code.
And we're not just talking about incremental increases here. We're talking about building data center capacity equivalent to powering several million homes, all localized into these dense new zones. The existing grid infrastructure, which hasn't seen a massive structural overhaul since, the 1950s, it was just not designed to handle that kind of localized exponential load.
No way. And this realization led Michael Burry to propose a very specific, and I would say radical, policy intervention for decision makers. He noted that since the government and corporations are throwing trillions around so freely, why not take 1 trillion of that and dedicate it entirely to solving the energy infrastructure crisis?
And his solution was specific and pretty controversial.
It was. He proposed 2 things. First, building a brand new, world-class electric transmission grid capable of handling these distributed massive loads. And second, and crucially, sprinkling the nation with small, protected nuclear reactors.
That's a massive commitment to nuclear energy.
It is, but his reasoning is purely economic and, focused on national security. He argues that guaranteeing unlimited, cheap, reliable power is the only way to ensure the long-term economic growth that we need to pay down national debt and guarantee security. Innovation must not be limited by energy constraints.
And Jack Clark, the insider, he strongly concurred with this focus on energy infrastructure investment. He saw it as the defining choke point.
Yeah, he also noted that these massive AI data centers are actually ideal anchor customers for novel energy technologies like small modular reactors. If you can guarantee a constant, enormous buyer for clean, reliable power, you immediately make the economics of new nuclear technology viable.
And that completely shifts the investment thesis. It moves from a battle of who has the best chip to who has the cheapest, most reliable power source.
Exactly.
So to wrap up this deep dive, the experts provided these specific quantifiable metrics they're personally using to judge whether the boom is healthy or if it's running off the rails by 2026. These are the verification bets that you should be tracking over the next year and a half.
Okay, let's start with Michael Burry's metrics. His are, fundamentally financial and focused on profitability and asset management. So first, he needs to see application layer revenue. That's the money actually being paid by customers for using AI services, not just the money being spent internally on hardware exceeding $500 billion. If the revenue from the application layer doesn't monetize at that scale, the infrastructure spend is simply too big to be sustainable.
Okay, that's a hard number. What's next?
Second, he wants structural proof that the efficiency gains are finally overcoming that closed-loop hurdle. He wants to see autonomous AI agents replacing millions of white-collar jobs. That level of disruption would structurally prove the ROI, and it would change the economic calculus instantly.
And his third one.
Third, and this ties back to that depreciation nightmare, he's tracking chip lifespans. He needs to see technological progress slow down enough that chip lifespans extend to 5 or 6 years. If they remain stuck at 2 to 3 years of optimal use, the cloud provider's long-term profits will, in his words, collapse.
Because the rapid depreciation cycles will just endlessly devour their revenue.
Endlessly.
Then we have the metrics from the tech observer, Dwarkesh Patel. His are a little different.
Yeah, he's tracking the AI lab's cumulative revenue landing outside a very narrow range. either below $40 billion or above $100 billion.
So why that range?
Falling below $40 billion would signal a really unforeseen, rapid slowdown in monetization.
Yeah.
But rocketing above $100 billion would signal a sudden runaway boom that kind of confirms the whole AGI narrative.
Okay.
But his most compelling metric, I think, is technical. And it relates back to the problem of efficiency, solving the continuous learning problem. Right now, when you interact with an LLM, it's like extracting labor from a new hire every single day. You have to explain the context over and over again.
So if the model is my coworker, I have to re-onboard it every single morning.
Every morning. If they solve continuous learning, interacting with the model will become like onboarding a long-term coworker. It will retain context, learn your specific preferences and workflow, and accumulate knowledge over months. That would be a huge step function in productivity release.
Because it would solve the verification and error checking problem instantly.
It really would.
And finally, the insider, Jack Clark, offered a technical fear he's tracking. What's that?
His fear is if scaling hits a wall. A true, unexpected bottleneck in the underlying research paradigm that just starts the exponential improvement. His entire investment model, the entire industry's trajectory, is predicated on the continued viability of the scaling laws. If that capacity curve unexpectedly flattens due to some unknown physical or mathematical limit, that would be the single most surprising and disruptive event for the entire industry.
So they concluded by contrasting their highest fears.
Yeah, and they were very different. Clark's primary fear is technical. Recursive self-improvement leading to systems that accelerate so quickly they become impossible for humans to understand or control. He calls for immediate policy attention to transparency and safety testing.
But Michael Burry offered a profoundly different existential risk.
Right. Having grown up during the Cold War, he just doesn't fear the AGI destruction scenario. His fear is financial collapse, yes, but it's also this subtle societal risk of chatbots making people dumber.
The atrophy of human expertise.
Exactly. He fears doctors over-relying on a smart diagnostic tool might forget the innate medical knowledge that makes them reliable in a crisis. When the tools become too good, humans stop doing the hard work, and the cognitive resilience of the whole population just declines.
That is a terrifying long-term risk. The tools are successful, but they hollow out the core human expertise they were supposed to be assisting.
That's a dark thought.
It is. Okay, let's unpack all of this and bring it home for you, the listener. # tag outro.
What an incredible analysis. It's this perfect blend of, deep technological optimism with an equally deep financial skepticism.
We've established that the technological capability is truly the floor of the future. It is spectacular and it is accelerating.
But that is juxtaposed against a financial structure that's defined by this massive capital deployment, complex accounting maneuvers, and a very real deflationary pressure.
The necessity of tracking those 5 lines just couldn't be clearer. You have to ignore the headlines and track capability, efficiency, capital return, the industry closed loop, and maybe most pressingly, energy supply.
If any one of those fails to accelerate, the entire economic structure might be revealed as just too fragile to support the weight of this trillion-dollar investment.
And before we close, let's end with that final, highly provocative thought that was derived from Michael Burry's personal anecdote about his own use of LLMs.
This was fascinating.
Burry, who is a notoriously intense, detail-oriented financial mind, he admitted he uses advanced models like Claude constantly for his professional work.
He no longer spends hours wrestling with Excel VOEPs, or building complex charts, or generating massive data visualizations from raw source material. The AI just does that in minutes.
He also uses it for highly specific personal tasks. He talked about getting detailed step-by-step guidance on DIY plumbing and electrical repair, completely bypassing the need for expensive, time-consuming consultations.
Facing an $800 plumber fee, he'd rather just use Claude to figure out the problem himself.
And this is the crux of the lesson for all of us. While AI has not yet caused a macroscopic job collapse that you can see on a spreadsheet, it is already rapidly commodifying and eliminating the need for highly paid human experts in tedious, high-friction, specialized tasks.
So if AI is already performing the role of an instant, high-quality private tutor, a data visualization expert, and a basic trade consultant, then the challenge for every individual, regardless of their field, is to identify where the human premium truly survives.
And that premium, it won't be in processing data or making spreadsheets. It has to survive in areas that require deep critical judgment, managing complex accountability chains, or, fundamentally in building and maintaining non-commodifiable human relationships. That's the hard work that remains.
Exactly. Don't worry about the total job count just yet. Worry about the value of your most high-friction, specialized, easily automated tasks that you do today, because that is the first thing that AI will eat, and it will drive down the price of human expertise everywhere.
Thank you for joining us for the deep dive. Continue tracking those economic and technical variables we discussed, and we'll see you next time.